Dale Smothers with R.D. Smothers Wealth Management coming to you once again just to talk to you a little bit about what's going on in the markets. As you're well aware, the market has gifted us with another burst of volatility and the headlines are starting to look apocalyptic once again. Market swings go from bad to worse to not so bad and then back to bad again. It's times like these that make it really difficult for us to understand exactly what we are supposed to do. A lot of people probably feel as if bailing out of the market right now is a good idea, but let me tell you why I think that may be a mistake, especially if you're looking for your money to grow in the stock market. If you're not looking to generate income, holding on to this money, holding on to the assets you possess, most likely is the best course of action. First, let's peel back some layers to explore what's driving this market and why it's been behaving so wildly. This latest sell-off was largely due to the concerns that the Federal Reserve's interest rate hikes could definitely affect our economic growth. And that's not without validity. I think that that's a valid point, a valid concern. The Fed's hawkish policy, rapidly raising interest rates, driving down inflation, it seemed like it could potentially take a chunk out of this economic growth. So I want to ask you, is a recession or a bear market on the way? Well, those risks are definitely risks that we need to prepare for. While the Fed could manage to execute this soft landing that they continue to talk about, where they're successfully lowering inflation without triggering a downturn, it's a track record that doesn't look so good if you look at the history. According to Charles Schwab, 10 out of the last 13 rate hikes have actually resulted in a recession. And those aren't odds I'd be willing to take. Not in Vegas, and definitely not with my retirement. However, we're holding to a couple of strong cards in this rate hike cycle that we've never really seen before, such as a red-hot jobs market and a steady consumer spending habit. I think those things could hopefully be a bright spot as we begin to look at this recessionary potential. It could hopefully fend off the recession and hopefully keep us from a downturn. It's very possible that this could be the case, but we're definitely going to have to wait and see. But here's one thing that I want to ask you. Are the 70s back? Are we looking at a 70s style stock market? Now, I'm not talking about bell bottoms and platform shoes. I'm literally talking about something called stagflation. You may be asking yourself, what does stagflation mean? I think you're going to start to hear that term a lot in the news here lately because stagflation is a buzzword combining the word stagnation and inflation, and it signifies an economy that is essentially plagued with low economic growth, high inflation, and high unemployment. We saw this in our country in the 1970s during the oil crisis. It's hard to say that it's going to happen again. It's definitely a risk that we and the world's economy should be watching. However, there are 2 points that could count against this vintage 1970s stagnation scenario: a strong jobs market and an inflation that may be reaching its peak. Those two things, a strong jobs market and an inflation that could be reaching its peak, could keep us from this stagnation, or let's call stagflation scenario. So let's not panic at this point in time, but the bottom line is that you've probably already heard me say this several times. Market downturns, recessions, and volatility can and should happen regularly. If you are needing income, go ahead and start considering the moves necessary to generate that income, especially if you're needing income in the next couple of years. But reacting negatively or reacting emotionally to downturns, recessions, and volatility, that's just not a wise decision. And if you've got a well-written plan, you should have already expected those things. You should have already planned for those things. And we must remember that these things do not last forever. So at R.D. Smothers Wealth Management, we stay nimble and we are consistently looking for opportunities. Though it looks like we may be in for a rocky summer, no doubt, and potentially even into winter. And then into spring of next year, perhaps still seeing this rocky and volatile market, I don't think it's time to hit the eject button. Now, I do think that we need to make careful shifts, and especially in this rising interest rate environment. Consider where your money is setting. If it's in bond funds, consider an alternative. And in the weeks ahead, we are very likely to continue to see this volatility, but I'm here, I am watching, and I will be in touch with you as it is needed. So once again, I appreciate your time. I thank you for watching this video. And I hope that as stagflation becomes the new buzzword, we don't actually see this take place in the market. But if we do, always remember that with a well-written plan, you too can consecutively and consistently navigate these times of volatility while not having to rely on the success of the stock market to be successful in your retirement income. I always enjoy talking to you. I hope that you've gotten a little bit from this video. But until we talk again next time, always remember to save money, plan well, and live happy in retirement. God bless.